Welcome, everyone. Today we're looking at Topic 4 in your SS2 accounting series, Provisions and Reserves. This is a very important topic. Provisions are amounts set aside to cover expected future expenses or losses. Reserves are amounts set aside from profits for specific purposes. This topic appears regularly in your examinations. You must understand the difference between provisions and reserves, the types of each, and how they are recorded. Pay close attention. Let us begin. First, let me explain what provisions are. Provisions are amounts set aside out of profits to cover expected future expenses or losses. They are created when there is a probable obligation. The amount of the obligation can be estimated. Provisions are recorded in the profit and loss account as an expense. They are also recorded in the balance sheet as a liability. Provisions are created for specific purposes. Examples include provision for bad debts, provision for depreciation, and provision for income tax. Provisions are based on the prudence concept. This concept requires that expenses and losses are recognized as soon as they are anticipated. Understanding provisions is essential for preparing accurate financial statements. This is a key concept. Now, let me explain the characteristics of provisions. Provisions have several characteristics. The first characteristic is that they are created for a specific purpose. They are not general reserves. The second characteristic is that they are based on estimates. The amount is an estimate of the expected expense or loss. The third characteristic is that they are created when there is a probable obligation. The obligation must be likely to occur. The fourth characteristic is that they are charged against profit. They are recorded as an expense in the profit and loss account. The fifth characteristic is that they are shown as a liability in the balance sheet. They reduce the profit and increase the liabilities. Understanding these characteristics is essential for identifying provisions. This is frequently tested. Now, let me explain the types of provisions. There are several types of provisions. The first type is provision for bad debts. This is created to cover expected losses from debtors who may not pay. The second type is provision for depreciation. This is created to cover the reduction in value of non-current assets. The third type is provision for income tax. This is created to cover expected tax liabilities. The fourth type is provision for warranty claims. This is created to cover expected costs of repairing goods under warranty. The fifth type is provision for legal claims. This is created to cover expected costs of legal disputes. The sixth type is provision for restructuring. This is created to cover expected costs of reorganizing the business. Understanding the types of provisions is essential for preparing financial statements. This is frequently tested. Now, let me explain what reserves are. Reserves are amounts set aside out of profits for specific purposes. They are created from retained earnings. Reserves are not expenses. They are appropriations of profit. Reserves are recorded in the balance sheet as part of owner's equity. They increase the equity of the business. Reserves are created for various reasons. They can be created to strengthen the financial position of the business. They can be created to provide for future expansion. They can be created to meet legal requirements. Understanding reserves is essential for understanding the financial position of a business. This is a key concept. Now, let me explain the characteristics of reserves. Reserves have several characteristics. The first characteristic is that they are created from profits. They are not charged against profit. The second characteristic is that they are appropriations of profit. They are distributions of profit to reserves. The third characteristic is that they are shown as part of owner's equity. They increase the equity of the business. The fourth characteristic is that they are not liabilities. They are not owed to anyone. The fifth characteristic is that they can be used for various purposes. They can be used to finance expansion or to meet contingencies. Understanding these characteristics is essential for identifying reserves. This is frequently tested. Now let me explain the types of reserves. There are two main types of reserves: general reserves and specific reserves. General reserves are created for no specific purpose. They are also called revenue reserves. They are used to strengthen the financial position of the business. They can be used for any purpose. Specific reserves are created for a specific purpose. They are also called capital reserves. They cannot be used for general purposes. Examples include share premium account and revaluation reserve. Specific reserves are created from capital profits. They are not available for distribution as dividends. Understanding the types of reserves is essential for preparing financial statements. This is frequently tested. Now, let me explain the difference between provisions and reserves. Provisions and reserves are different in several ways. Provisions are created to cover expected expenses or losses. Reserves are created from profits for specific purposes. Provisions are charged against profit. Reserves are appropriations of profit. Provisions are shown as liabilities in the balance sheet. Reserves are shown as part of owner's equity. Provisions are based on estimates. Reserves are based on actual profits. Provisions reduce profit. Reserves do not reduce profit. Provisions are created when there is a probable obligation. Reserves are created when there are retained earnings. Understanding this difference is essential for correct accounting treatment. This is frequently tested. Now, let me explain the difference between general reserves and specific reserves. General reserves are created for no specific purpose. Specific reserves are created for a specific purpose. General reserves are available for any use. Specific reserves have restricted use. General reserves are created from revenue profits. Specific reserves are created from capital profits. General reserves are shown as part of retained earnings. Specific reserves are shown separately. General reserves can be used to pay dividends. Specific reserves cannot be used to pay dividends. Understanding this difference is essential for preparing financial statements. This is frequently tested. Now let me explain the difference between revenue reserves and capital reserves. Revenue reserves are created from revenue profits. Capital reserves are created from capital profits. Revenue reserves are available for distribution as dividends. Capital reserves are not available for distribution as dividends. Revenue reserves include general reserves and specific reserves. Capital reserves include share premium account and revaluation reserve. Revenue reserves are created from trading activities. Capital reserves are created from non-trading activities. Revenue reserves are shown as part of retained earnings. Capital reserves are shown separately. Understanding this difference is essential for preparing financial statements. This is frequently tested. Now, let me explain the importance of provisions. Provisions are important for several reasons. First, they ensure that expenses are matched with revenue. This is the matching concept. Second, they ensure that the financial statements show a true and fair view. Third, they ensure that profits are not overstated. This is the prudence concept. Fourth, they ensure that liabilities are recognized. This is important for users. Fifth, they help in tax planning. Provisions reduce taxable profit. Sixth, they help in decision-making. They provide information about expected expenses. Understanding the importance of provisions is essential for understanding why they are created. This is frequently tested. Now let me explain the importance of reserves. Reserves are important for several reasons. First, they strengthen the financial position of the business. They provide a buffer against losses. Second, they provide funds for future expansion. They can be used to finance growth. Third, they help to meet legal requirements. Some reserves are required by law. Fourth, they help to maintain dividends. They provide funds for dividend payments. Fifth, they help to build confidence. They show that the business is financially strong. Sixth, they help to meet contingencies. They provide funds for unexpected events. Understanding the importance of reserves is essential for understanding why they are created. This is frequently tested. Now let me explain the limitations of provisions. Provisions also have some limitations. The first limitation is subjectivity. They require estimates. The estimates may be inaccurate. The second limitation is manipulation. Provisions can be manipulated to manipulate profits. The third limitation is complexity. They can be complex to calculate. The fourth limitation is cost. They cost money to calculate and record. The fifth limitation is time. They take time to calculate. Understanding the limitations of provisions is essential for a balanced view. This is a key concept. Now let me explain the limitations of reserves. Reserves also have some limitations. The first limitation is opportunity cost. Funds set aside as reserves cannot be used for other purposes. The second limitation is tax. Reserves may be subject to tax. The third limitation is distribution. Reserves reduce the amount available for distribution as dividends. The fourth limitation is misuse. Reserves can be misused by management. The fifth limitation is transparency. Reserves may not be transparent. Understanding the limitations of reserves is essential for a balanced view. This is a key concept. Now let me give you sample exam questions to prepare you for your test. What are provisions? Provisions are amounts set aside out of profits to cover expected future expenses or losses. What are reserves? Reserves are amounts set aside out of profits for specific purposes. State the characteristics of provisions. They are created for a specific purpose, based on estimates, created when there is a probable obligation charged against profit and shown as a liability. State the characteristics of reserves. They are created from profits, appropriations of profit, shown as part of owner's equity, not liabilities, and can be used for various purposes. List the types of provisions. Provision for bad debts, provision for depreciation, provision for income tax, provision for warranty claims, provision for legal claims, and provision for restructuring. List the types of reserves. General reserves and specific reserves, revenue reserves and capital reserves. Explain the difference between provisions and reserves. Provisions are charged against profit and shown as liabilities. Reserves are appropriations of profit and shown as equity. Explain the difference between general reserves and specific reserves. General reserves have no specific purpose. Specific reserves have a specific purpose. Let me summarize everything we have covered today. Provisions are amounts set aside out of profits to cover expected future expenses or losses. Reserves are amounts set aside out of profits for specific purposes. Provisions are charged against profit and shown as liabilities. Reserves are appropriations of profit and shown as equity. Provisions include provision for bad debts, depreciation, income tax, warranty claims, legal claims, and restructuring. Reserves include general reserves and specific reserves, revenue reserves and capital reserves. Provisions are based on the prudence concept. Reserves are based on retained earnings. Provisions and reserves are important for accurate financial statements. Understanding provisions and reserves is essential for accounting. This is topic 4 in your SS2 accounting series. Study it well. It appears regularly in your examinations. Well done.